Let's discuss how to make $100 each day with dividends beginning at $0. With the stock market already down more than 20%, the economy in shambles, and inflation spiraling out of control, the situation is dire. Dividends can help offset the loss of a stock's value. They increase when the market declines, and anyone can begin earning extra cash with as little as $1. Therefore, let's explore precisely what you could accomplish, including the pros, cons, and ugliness of dividends, as well as the method with the greatest potential for profit, and the blueprints you could use to move from $0 to $100 every day. Welcome to the Financial Flow. Please like and subscribe to our channel and turn on notifications to stay up on our latest videos. Okay, in terms of where to begin, we must discuss the fundamentals of dividends. When you purchase a stock, you are entitled to a piece of the company's profits, which are periodically delivered to you in the form of dividends. Consequently, if one share yields $5 annually and is now trading for $100, you will receive a return of 5%. The dividend yield could increase or decrease based on the price of the stock. Moreover, not all stocks pay dividends, but when they do, they typically vary from less than 1% to more than 10% depending on the firm. However, you will typically find the strongest equities paying anywhere from 1% to 5% annually, which will likely be the simplest passive income you will ever get. In addition to the stock price possibly increasing, the upside from an investment aspect is that you will be able to obtain predictable cash flow on a regular basis without selling any shares. This leaves you with extra funds that you may use to reinvest in more assets or buy a jet ski if that's your thing. Nonetheless, like with any endeavor, there are benefits and downsides to consider if you want to grow this up to $100 each day. Here are the challenges you will face. Let's begin with the positive. Item 1. You are protected against the stock market. The majority of the time, you will receive the exact same dividend payment regardless of whether the company is trading for $20 or $40. For investors seeking constant cash flow, this helps to smooth out market fluctuations. Second, dividend payments are much more stable than stock prices. Third, dividend payments periods actually rise during recessions. It has been demonstrated that fourth dividend stocks offer returns comparable to the whole market. In fact, they discovered that dividends provided for 54% of market returns when inflation was above 5%. This means that, while they may not be the stocks that rise the most during bull markets, they also do not lose the most during down markets. And fifth, depending on your tax bracket, dividends could be taxed at a lower rate, but we'll cover this in greater detail at the end of the video. However, if you receive a qualified dividend, you could pay no tax at all if you're single and make less than $41,000 per year, or married, and make less than $83,000 per year. However, despite the fact that all of this sounds amazing, we cannot have a balanced debate about dividends without also discussing the disadvantages. First, dividend payments are not assured. Although corporations strive to prevent cutting or lowering payouts, it does occur. And because dividends are a reflection of the company's profits, they may choose to turn off the money tap until conditions recover during a slump. Second, dividend payments are meaningless when the company's value drops. In this instance, a 5% yield could actually result in a loss if the stock loses 30% of its value. And there are several examples of this. There's a potential that the price will rebound while you collect all that cash flow, but there's also a chance that it won't, and that must be considered. Third, although there may be tax advantages, there may also be tax disadvantages. Unlike purchasing a stock and paying tax only when you sell it, dividends are taxed the time you receive them, and depending on your tax bracket, the tax rate might be as high as 20% or more. And fourth, dividends may be completely irrelevant. Two prominent economists claim that dividend payments are irrelevant since they have no effect on a company's cost of capital. In this case, they explain that if an investor needs money, all they have to do is sell their stock, and that dividends don't create any additional value for the company. It's similar to saying that instead of paying a 2% dividend, the stock price will increase by an additional 2%, leaving you with the same amount of value in both cases. Overall, it's important to note that savers are now being rewarded, despite the fact that most assets are declining in value for the first time in years. Okay, So in terms of establishing a dividend portfolio, contrary to what most people believe, there are some firms that have never missed a dividend payment. Before discussing the step-by-step strategy for building passive income, we must first discuss the dividend aristocrats. This is a select group of 65 in the S&P 500 companies that have consistently increased their dividend payouts for more than 25 years. They meet a strict criterion of growth size in their ability to continue increasing their payouts, and they have outperformed the S&P 500 by nearly 1% annually over the past 30 years. In reality, there have been only 2 years of negative growth in the recent 2 decades in 2008 and 2018. Moreover, dividend aristocrats have maintained above average growth, and a sizable portion of their businesses tend to outperform the market during a recession, and despite the possibility of price declines, they tend to decrease far less than the market as a whole. Not to mention psychologically, receiving dividends make it much easier as a long-term investment strategy, because by consistently receiving scheduled payouts, you're much less likely to worry about day-to-day fluctuations or panic sell when you see everything falling in price. Here is a passive income method, the first of which is real estate. If you own a rental property, you may be able to earn $1,000 each month, but it requires a great deal of effort. You'll likely spend a year looking at houses and making offers, a few months fixing it up, and another month renting it out, just to lose everything when the tenant stops paying rent. Let's say you've continued to purchase rental properties in California, and have had a generally positive experience. With a current cash flow of about $22,000 per month, not only did this require a lot of work, but you could also manage a few of the properties on your own. And there are still random expenses that must be accounted for. YouTube would also generate passive revenue. YouTube requires that you regularly upload material, so this is a full-time work, but everything else, including affiliate marketing, internet programs, self-storage, facilities, and absentee-owned firms, carries a high degree of long-term risk and a low probability that income will continue to increase. Third, dividends. From Apple to Exxon to Simon Property Group, that pay anywhere between 0.5% and 5% in dividends. They use the mundane technique of dollar cost averaging on a regular basis, regardless of the price at which they trade. The objective was that dividends would never be the primary emphasis of a portfolio, but that they would provide a continuous source of income. Dividends could be the frosting on the cake as opposed to the cake itself as time passes. Therefore, in terms of how you may create your own frosting on the cake, passive income portfolio that generates up to $100 per day starting from nothing. Here's my own advice. If your goal is to generate $100 per day as quickly as possible, the simplest solution is a simple arithmetic equation. If your average dividend yield is 3%, you will need to invest $1.2 million to reach $100 every day. This is not unreasonable. By investing an average of $17 per day for 35 years, you should be able to reach this goal. You could reach your objective in 28 years if you invest $30 per day, and in 22 years if you invest $50 per day. Furthermore, if you invest in a company that pays more than 3%, you could reach your goal with much less. But thankfully, many of these companies end up increasing their dividend payments over time, so the return may actually increase at a much faster rate than anticipated. Despite the fact that accomplishing this will either need a lot of time or a lot of money, I believe this is what discourages so many people from even attempting it. After all, it's not the effort, since once you open a brokerage account and enable auto invest, you're pretty much done in 20 minutes. Rather, it's the frustration of staring down another 20 years and thinking, this is going to take too long, I'd rather day trade crypto. I've never met anyone earning $5 a day passively who wasn't ecstatic about the prospect of earning money without having to work for it. Once you see the momentum building, you'll become just as obsessed as other people have already invested, and you'll do whatever it takes to continue to grow it because it's enjoyable. However, keep in mind, similar to the VF and Walgreens examples, even solid dividend aristocrats could be risky if the underlying stock declines in value, and sometimes it may be better to forego the dividend in favor of stock growth. Although, I believe a well-diversified portfolio should contain a mix of both. On the one hand, dividends should reduce volatility, provide constant cash flow, and leave you with more money to reinvest. On the other hand, Dividends should assist you increase your net worth, even if your portfolio appears volatile in the short term. Thanks for watching. Don't forget to leave a like and subscribe to our channel for more content like this. Have a good one.